Hello everyone, my name is Muad, and today we're going to discuss the Bethesda mining company, and we're going to discuss the case, and at the end we'll see if we should take the project or reject it. Here is the outline of my presentation. So at the beginning I'm going to give a brief about the case and explain the case. Then we're going to calculate the MVP, the net present value. And then we're going to calculate the payback period and internal rate of return and the profit index. At the end, I'm going to give the conclusion and the answer of should we take the project or reject it. The case of the Bethesda mining company is really simple. They have been approached by an electronic company with a request to supply coal because the Bethesda mining does not have enough access capacity at the existing generation to the contract. And now the company consider opening a new strip mine because there have been changing regulations that force the company, after finishing the project, the land must be restored to the near original condition. And to increase the capacity, the company must buy additional equipment, about $43 million, and the equipment can be sold only for 60% of the price. Here is some value that we're going to use in our case. So at first we're going to calculate the net present value, and that will show us the future generation cash flows, if it is positive or negative, and shall we pursue with the project or shall we stop it. And to do that we're going to go through 3 steps. First we're going to calculate operation cash flow, and then calculation of cash flow as a result of net working capital, and then we're going to do the tax deduction, and then we're going to calculate the net cash flows. In order to do the first step of the net present value calculations, we're going to find 2 major parts. First, we're going to find total sales in each year, and then we're going to calculate this depreciation in each year by using CRS procedure. So you can see here the total sales collection. We use the tons produced, like 750,000 for the first year, and second year is 810,000, and so on to the 4th year. And according to the question, they said that they are going to be required 500,000 of tons every year at a rate of 60. So when you multiply that with the value, you get the 30 million on contract sale in the first year. It will be 250,000, which would be access if you multiply it with the 48 spot sale price. It will be 12 million, and in total you will get the 42 million sales for the first year. And that's how the calculation of the total sales for the 4 years. Then we calculate the depreciation, the rates. You see that these rates have been provided by the IRS according to the MCRS depreciation methods. The equipment cost has been given 43 million. If you multiply it with the every rate, you'll get the value. For example, for year number 1, you'll get the value 6.1 million. And so on and so on, but our project only for the 4 years, so only we need the ending of the year number 4, and which you can see it's the rate is 30 million and 433,200. So we have done the calculation of the operation cash flow. You can see the total sales, which we have taken from the previous slides. We calculated the variable cost, and fixed costs have been remained 3.7 million for the 4 years. The depreciation we already collected in the previous slide. So when you list the values just according to our normal procedures from the total sales, you got the profit before tax, and the tax as required from the question is 38%. When we less the tax from the profit, we got the net income. In order to get operation cash flow, we must add the depreciation back so we can get the operation cash flow. Now we cover all the operation cash flow for the 4 years. This is the calculation of cash flow as a result of net working capital. So as you see here, the net working capital requirements are 5% of the next year's sales. So in the first year, you got 42 million sales in total. So if you take a 5% of it, you get the 2.1 million. And this is how all the sales have been calculated. Year 4, it will be 0 because we don't have sales of year 5. Increase in net working capital would be in the year 1 negative. So if you less the 2.1 million from 2.44, you get the minus 144. If you continue in the same process, you will get the positive 246,000 in year 3, and in the end you got positive net working cash flow. In this slide, we will do the collection of the tax deduction rate. The tax deduction plays a very important role here because at the end of the year 5, the company is gonna reclaim due the reclamation. This is gonna consider it under the charitable expenses of 7.3 million. So they must deduct the tax from it, because if they face any kind of losses in their cash flows, they can use that credit to reduce their loss. So 7.3 million multiplied by 38%, that gives us 2.7 million of tax deduction. Now we need to calculate the after-tax salvage value. So we have the pre-tax salvage value is 25.8 million. And in the question they told us the equipment cost 43 million, and they're gonna sell the equipment at the end of the year 4 and get the price of almost 60%. So the ending value we already calculated in the previous slide. So we just now do the formula, the pre-tax salvage value minus pre-tax salvage value minus ending value multiply tax rate. That gives us the after-tax salvage value 21,100,616. This is the last major slide of the net present value calculation. We have here everything in consideration of 5 years, because after 5 years we need the reclamation and the tax reduction. The main purpose of the calculation is to find the net present value. We have here the net cash flow, and it is a result of operation cash flow minus the cash flow as a result of net working capital. Then we use the net cash flow, added it with the initial investment, and calculate the net present value. Payback period is defined as how much time to get your money back from investment in assets. So the sooner you get the money back is the better. We have here 5 years of net cash flows available, and we have done the cumulative cash flow. We just list the results in every year, and we see where the cumulative cash flow goes from negative to positive. In this case, from the second year to the third year, the cash flow are going from negative to positive. So we take the second year cumulative cash flow and third year net cash flow to get 0.935. Since it's happening in the second year, so we added 2, so it will be the payback period time, it will be like almost 3 years, 2.94. And the net present value shows at what points the present value of the cash flow will be 0. In this case, the required return rate was 12%. As we got the IRR of 20.78, I collected it through the PA plus calculator after collecting the MPV. If the IRR exceeds the company required rate, that means the project is desirable. As we see here, that number gives us a hint that we should proceed with the projects. This is the last step of whether we should continue with the project or not. To calculate the profit index, we add the net present value with the initial investment and just divide it with the initial investment. So mostly, if the profitability index higher than 1, that shows that you should proceed with the project, and the profit index that we have here is 1.21. After we got the positive net present value, and we got the IRR more than the required return, and we got the profit index more than 1, it is 1.21, now we can say that we should accept the project. Thank you for your attention, and I hope you have a nice day.